Hi, this is CF Liu. At a certain point of your life, you may wonder, should I pay off mortgage or invest? Bank can't really answer you. They are not trained to answer you. They don't know. Well, they are not motivated to give you that answer. You just have to find out on your own because it does not really benefit bank if you pay off your mortgage early. And here becomes a problem. At the end of this lesson, I'm going to show you that the exact process that could easily save you 5 figures or even 6 figures over a period of 20-30 years. And that is just easy money, what I call as a low-hanging fruit. I'm going to walk you through the process step by step, what you should consider and how you should think or calculate to decide whether you should pay off your mortgage early or to invest that money. Now you could go online and there's a lot of these online mortgage calculator that you can use. You just put in the price that you bought your property at. Interest rate is about 4%. Put in your interest rate, put in the loan duration. And for this exact example, I'm actually buying a property worth 800,000. Now that is a very normal price for a property located in the city center. So if you pay a 10% deposit, naturally the loan amount is 720,000, and with that you are expected to pay around 4,300 per month. If you do not do any extra principal repayment over the entire duration, you are expected to pay the bank in a total of 327,000. Now let's take this as a baseline scenario. Now the second scenario I want to show you is everything being the same, we just change one thing. Put the loan duration from 20 years and then you just lengthen it to 30 years. You would be expected to pay, of course, around 900 lesser per month, from 4,000 something, 4,003 to 3,004. However, over the entire duration, you'll be expected to pay an interest of 517,000 to the bank. Just by shortening your loan duration by a period of 10 years, you can see that you are saving around 190,000. Easy money.
Are you unsure how much longer you should hold on to your worst performing real estate investment property, or whether you'll be better off selling it as soon as possible? You get tired of attending property investment seminar by property gurus who are still trying to convince you property investment is still as easy and profitable as 5 years or 10 years ago. Well, they might be right, or they might have their own agenda for saying so. Want a non-biased second opinion? I'm conducting an online web class this week to answer this burning question. You are also going to discover if your property is at risk of not able to increase your tenant's rental in the future. If you feel you're going to benefit from these out-of-the-box insider insights, click on the link in the description below after you finish watching this video, and it will bring you to a page that looks like this. No credit card required, but availability is limited. We get filled very fast. Seats are reserved on a first-come, first-served basis.
On top of that, you also have more cash flow or surplus every month if you are paying for a loan that stretches to 30 years instead of 20 years. Remember, we are talking about 3,004 versus 4,003. So you save around 900 per month, but you don't just put that 900 per month below your bed. You put it into something, an investment that generates you on an average 6% per year. Now, this is a very realistic kind of assumption. 6% per year is really not hard to get. Now, in my REAP method course, I actually teach all my clients and students how to get that. Now, if you are interested, check out the link below. Now, for 30 years, if you were to have 900 per month, 900 per month compounded at a 6% per year for 30 years, that would actually equals to around 900,000. But you have to invest it diligently and with discipline. Then you will end up with almost like $1 million after 30 years. Now don't forget the other scenario where you take a 20 years loan and you pay around 4,300 of mortgage repayment a year. Look at this again. If you have paid off your loans, your mortgage by the 20th year, and then on the 21st year until 30th year, which is in a period of 10 years, you would have an extra surplus of 4,300 per month, right? Because you are not paying any mortgage repayment anymore. You don't just spend this money, if you were to actually take this money and let it again compound at a 6% per year, you would end up with a 700,000 in just a short period of 10 years. So just to recap, one of the scenario is whereby you have your 30 years loan, you end up paying 190,000 more to the bank. End up the difference that you save every month, if you were to invest it at 6% per year, you are going to get around 900,000 at the end of the 30th year. But if you go for a shorter loan duration, in this example 20 years, for an 800,000 property where you pay 10% deposit, 720,000 of loan, we haven't really considered all the incidental costs, your legal fees and all that. That is not the purpose of this lesson, right? The purpose of this lesson is to show you the process, how you should be actually calculating this entire consideration, whether to pay off your mortgage early or to invest. So in the scenario where you have a 20 years loan, you actually pay 190,000 less to the banks, but you free up around 4,300 per month on the 21st year to the 30th year, which if you were to invest that equally at 6% per year, you would actually gain 700,000 within that final 10 years. So is one scenario better than the other or not? Well, obviously this kind of consideration will change depending on how much loan that you actually take, but I'm just showing you the exact process, right, of how you should consider the scenario on a very quantifiable manner. I have a better, more flexible solution for you. If you are just starting out, you don't really want to commit to a high monthly loan repayment, even though that comes with its disadvantages, which ends up paying more interest to the bank. Look, you're going to take a 30 years loan, and then when your monthly cash flow is actually way better, either it's through promotion or you get a salary increment, or you change your company, you could still make extra capital or principal repayment to your mortgage account. Every single month, the bank just needs you to pay 3,004. But regardless of that, if you were to actually self top up another 900, that is like equivalent of taking a 20 years loan anyway, right? So if you do that from day one, end of the day, of course, you will be saving the same kind of interest amount, but without over committing yourself to pay 4,300 every single month. So my advice is be flexible in this scenario, but also be very disciplined. Pay off mortgage early or invest for working people, for working professional, and for employee. The other angle is if you are about to retire or you are a retiree, you still have a mortgage loan tied to your name, then you might also wonder whether I should pay off mortgage early or invest. I think I want to make another lesson on that. And another angle that I really want to make another lesson is whether to pay off mortgage early or invest for a property investor. I want you to go below and let me know which type of lesson you want to see next, whether you want me to do a pay off mortgage or invest for property investor, or a lesson on pay off mortgage or invest for a retiree or someone who really planning for their retirement. If you like this lesson, give it a like and subscribe. I'll see you in the next lesson.